Welcome to the introduction to implementation of standard costing. In the last set of lectures, when we were focused on Chapter 7, we were talking about the development of the standard cost card. And at that point, we were creating a document and a set of forecasts that would help us, but we weren't doing the actual implementation of the information from the card into the system. That is what we do in Chapter 8. So this is an implementation chapter. We look at two main features of the implementation cycle of the standard cost system, and that would be the journal entries and the generation and interpretation of the variance analysis. So this lecture is devoted to an introduction to the topics that are in that area and some of the strengths and weaknesses and directions that we'll be going. So, a couple of remarks. When you're learning the variances, there are two main ways to do the variance. In the lectures, I will use the tableau or the table method. In the textbook, there's another method that I'll give you a couple of examples of, so you can see them with me. And it's the equation or formula method, and you can use either one. It doesn't matter. On an exam, whichever one you want to use is fine. For most students, when you're in the learning mode, looking at the table version is almost always better and more informative. But when you're doing your own work, many of you will decide that the equation method is actually better, and that's fine. So I would say my experience in this class is on the final exam, and there will be a giant problem on the final exam related to this. Somewhere between 35 and 45% of the students choose the equation method, and it varies a lot actually from semester to semester, but you'll know when you use it which one is right for you. So when you start to work some of these problems, I would urge you to do the setup both ways for one or two problems, and you will probably get a feeling for which one makes most sense to you. Then do most of your practice in the one that makes most sense to you. Both of them have a few little pitfalls and things to watch out for, so that means that you should practice a lot, whichever method you choose. In the classroom, the tableau method I think is much better. But it doesn't really work so well in a textbook because textbooks are so linear. There are two examples in your textbook of a table method. I believe it's Exhibit 6 and Exhibit 7, Chapter 8. It's like 8.6 and 8.7, I believe, are table methods. The main reason that it's not seen as a dominant method in the books, in any book, is that when they're trying to teach you something on a page, they want to have some text to discuss what you're doing, and the tableau method is so big that they couldn't fit the text on the page. So what you would end up with is one table, just like the complex tables I'll show you here on the board and that you'll see in Exhibit 6 and 7. And then it would be 3 or 4 pages to explain what happened there. So you would be looking at one page and having to flip back to see what they're doing. So what they do in almost all textbooks, is as they give you the meat and potatoes of the explanation of what's going on, they use the formula method, and then it'll be a formula, then 2 or 3 paragraphs of explanation, then the next formula, 2 or 3 paragraphs of explanation, and that's a good method. So that's one reason that you see the formula method more in the textbooks. It's just hard to place on the page, or excuse me, the table method is hard to place on the page. But here we go. So I'm going to give you an overview of the theme, what we're looking for in general. No numbers, though, for this first lecture. Okay, reinforcing a couple of the things we did last time, and strengthening some things. Standard costing system is not an accounting system. It's an accounting and budgeting system at the same time. That's one reason it is complex, is it's not doing just one thing. It is not, absolutely not, just recording stuff that happens. It actually has embedded in it budgeting elements in every single journal entry. So everything that is a standard is a budgeted item. So our entire system now is flipped. Like when we went from normal costing to standard costing, all of a sudden we were predominantly doing journal entries for budgeted items, not for actual items. And there's no account in the system that has an actual cost in it inside the factory. You can figure out what the actual cost is by taking the main account and the contra account and netting them out. that will tell you what the actual cost is. But the main account has only standards, and the contra account is the variance account. It has deviations from standards. To know what the actual amount was, you have to actually net them out. So there's nowhere in the system that there's an account that has a balance that is an actual cost. Okay? So we are primarily planning and budgeting at this point, not accounting in the sense of recording the results of prior transactions. Okay? So that's a big step. I'm going to illustrate, or I'm going to do sort of a graphic display on the board of what the table approach is trying to do. What we're doing is we are using our budgeting and planning system to evaluate how good we were at conducting our business, but also how good we were at actually doing the budgeting process. We're going to create 3 different income statements, and we're going to compare the difference between them. So we are going to prepare basically an actual cost income statement. We're then going to prepare what is basically a flexible budget income statement. Then we are going to prepare a standard cost income statement. Then we're going to compare these, and that comparison, the amount between these, will be the variance. The word variance is actually not a particularly important word. I mean, all accountants use it in textbooks. That's the only word that's used in textbooks. In real life, though, you don't have to use the word variance. It's not part of financial accounting definition of elements. So I have seen companies use a variety of words to do this. What we're going to do is, remember, this is an income statement. Every line on the income statement, for instance, DM, and it's going to be for every, and while I'm talking, I actually garbled the 2 pieces. I wanted to say DM1, and I said D1. So let's go back and talk a little bit slower. So you'll have a separate line here for every direct material that you have. If your company has 250 direct materials, you're going to have 250 items down here, because each one would appear separately on that income statement. Okay? We in class give you these income statements where you just sum up the total financial value of the direct material used. But when you're doing the analysis, you want to look at the value of each individual direct material used. So way to think about these columns, though, is each one is actually all the lines from an income statement. We don't have the income statement subtotals here, like cost of goods manufactured, cost of goods sold, or income before tax, or income from operations here. All we have is the cost elements that go into it, and we have their actual, we have their flexible budget amount, and we have the standard cost amount, and we are actually going to compute the difference between them, and that's going to be the variance. We're going to get a variance for each line all the way down. Okay, this entire column, maybe this would be a good time to use different colors, although, in the past, my red, I have a new red, so maybe it will work a little bit better. So this column, no, even in person, this red is terrible. So I will scratch that. You would think I could have tried it out before the video started. Okay, how about blue? Everything in this column is a purchasing or an acquisition variance, because when we look back at the definitions of these, we'll now add the next layer of information, which is this is actual quantity times actual price. This column is actual quantity times standard price. This column is standard quantity times standard price. This is a sort of a deep thing, so you might need to pause and sort of stare at this for a minute to figure this out. So that means that the difference, if you look at these 2 columns, what is the difference between these 2 columns? The AQ is the same, so we're doing actual quantities. What's different between these 2 columns is the P's, the price. We have 2 different prices. We're comparing actual price to standard price. So all the way down this column, every variance here is a price comparison. And so this can have a couple of different names. In In different line items for historical reasons, there's sometimes different names. For instance, this would often, for direct material, be called purchase price variance. And for direct labor, it's often called direct labor rate variance because that's an old-fashioned word. Well, not necessarily old-fashioned, but that is a word for labor pricing, meaning the wage rate or labor rate. There's no real official title for this. You can put purchase price all the way down, top to bottom, as long as you have some language in your journal entry that gives the idea that it's actually the acquisition or the purchase that is leading to the variance. So this entire column is purchasing. Okay? This entire column, look up at the top to see what the difference is. Notice that the prices are the same. We're actually holding the quantities difference. So this entire column is use variance. Okay? And notice that also for historical reasons, you see some differences in the name of the variance based on direct material versus direct labor versus overhead. Because down this column, you'll have all of those pieces. You'll have a set of direct labor items, okay? Probably several of them. Then you'll have, direct material items. Then direct labor, probably several different categories of direct labor. Then you'll have variable overhead and fixed overhead. In some cases, you will have multiple versions of both. What you can have is a different fixed and variable overhead rate for each department. Okay? So that would be more advanced, sophisticated problems. But stop. Now look at this. So this will give you the overall picture of what we're attempting to do in terms of these variances, is we are looking at the variance to see how good our forecast and our operations were for both the act of acquiring the resources, right? Because we have to go out and buy the materials, we have to hire the workers. And if you have a big factory, you want to use the right workers for the job. You don't want to use someone that's really overqualified and you pay too much. So actually choosing which worker is assigned to each job, it will have an impact on this column, right? Because that's your actual cost of the workers you used. This is the amount of resources that you used, meaning the number of kilos or pounds or whatever measure of the direct material is, number of direct labor hours. Did you use the amount that you forecasted? Your AQ and your SQ, are they same or different? And the same thing down for overhead. Once again, the variable and fixed overhead are the most confusing part of this entire puzzle, because the same reason they're confusing in chapter 7 is that especially fixed overhead doesn't really match the system. Mentally, our mental model in accounting is that all of these costs are variable costs. That's how the accounting system treats almost everything. So when we start dealing with truly fixed costs, there are rough edges in the accounting system itself as to how it actually handles fixed cost. So the problems you'll have as a learner are primarily down here, mainly in the fixed overhead, but also the variable overhead will give you more problems. Up here, look, you're still going to have to work hard. It's not easy, but there will be the more straightforward ones. They match, they're very systematic, and there'll be a pattern that you can recognize pretty easily after you practice them a few times. The problems you will get will be down there. Tracking these things in can be a little bit tough, but notice that I have the column definitions here. There's also a few tricks. This often, in many problems, you don't have to compute this. This is given. They tell you what the actual cost was in many problems. So this you can write down, you know what the value is, but you often don't have to actually figure it out. On the other hand, these you have to figure out. In almost every problem, you'll have to identify the AQ and the SQ and the SP. And often you have to do several computations to figure out what each of those is. Then you have to multiply them out and then finding the indicators here, then you find the variance by comparing the indicators. So it's a multi-level process that you have to go into. A couple of little warnings about the system. For direct materials, you have to do this one twice. because we buy, the amount of direct materials we buy is not the same as the amount we use, right? Because we can put them in inventory, or we can use last time's inventory. So that means in a flexible budgeting analysis sense, there are two different ways to compute this. We either compute this with the actual quantity that we bought, that's here, and do this variance. For this variance, we have to do this again, but with the actual quantity used. So that's over here. Okay? So that's a little bit of a trick that only applies in direct material. For everything else, it's just one indicator. Okay? So it's sort of like, a magic line here. When I do, that means it's a magic line. Down below here, everything is just one indicator, because you can't have an inventory of direct labor. When it's gone, it's gone. You don't get to buy it in one period and use it in the next. With direct labor, you buy it and use it in the same period. Same thing with variable overhead and fixed overhead. It's only one indicator. That's just a little bit of a mechanical deviation, and you will see this explicitly if you use this tableau or table method. So this is actually the table method. It's the way I prefer, because I get to line everything up and see it all at once, and then I can see if I have made any really goofy errors because I'm seeing all the pieces at once. Similar to the way I suggested that you make the standard cost card by mocking up the card and all the pieces, and then in the second layer going back and putting all the units that you know, and then only in the third layer start cracking the hard mental stuff and putting some of the numbers in there. I approached this variance analysis the same way. I set up the table, set up the headings at the top, and I always write these down, AQSP, AQSP. By doing this in layers, it makes the problem more docile because you're not trying to grab onto too many of the pieces at one time. And if you use the formula approach, you can see the formula approach actually right here. The formula approach just directly computes this. This approach computes these two income statement indicators, the actual direct material from the income statement purchased, and then the actual direct material purchased from a flexible budget perspective. And then you have to net them across. You subtract in this direction, this minus that. And the difference is the variance. The formula method just computes this variance directly. And the way it does it, you can just see it right here, right? Notice what's different. AQ is the same. So what you have is the variance is AQ times SP minus AP, okay? You can see that algebra right there if you do it. Maybe I'll write it out, which I wasn't planning to do. So this then is, box means it's, I'm illustrating a different system, not one that we would use on this table. It would be AQ times SP minus AP. You have to do it in this order because you need the sign to match up to the concept of favorable or unfavorable. So here's something you have to do. This is across all accounting textbooks and all accounting life, is that some parts of this system are canonical. Canonical is a word meaning like it's the law. And some parts you get to make your own decisions on. And so one of the canonical parts is anytime you have a variance, you have to identify it. After you have a number, you're looking at a number, you have to label that number as either F or you have to label it as U. F for favorable, U for unfavorable. If you do it like this correctly with SP minus AP, then any negative number that comes out of here is automatically a favorable, and you still have to put the U there for favorable. Doing that is canonical, meaning you don't have a choice. You can tell me, oh, but the sign will tell you, and I will say, yeah, you're right, but that's not the way we do it. You can leave the sign there, but we need the F or the U. Okay, that's part of the worldwide sort of way we do things. Where you have to be a little careful if you're doing the formula approach, you have to make sure you get these in the correct order so that your sign, either positive or negative, actually leads you in the correct direction. If you get a little nervous, and remember, as I mentioned, what happens to your intelligence on an exam? Does it go up No, it goes down, right? You're tired, you're nervous, stuff's happening. If you put these backwards, AP minus SP, that's actually wrong. Okay, so if you do the formula approach, make sure you always practice the directionality properly, and you'll see that in the book. It's always the same in the book. So that's a little comment on the formula approach. And you can see that you can, if you know the formula approach, you can backfill and derive this. If you know this table approach, you can see that the formula approach is just built from pieces of it. Formula approach is more direct. If you want to directly compute the variance, the formula approach is more direct. I don't really care about that. I'm really more interested in understanding the whole flow of things. And if you want to understand the entire system and all the flows, then the table method is best. But, on the exam, it's whatever you're more comfortable with, okay? So try one problem both ways. You will feel in your gut which one makes more sense to you. That's the one you should go after. So here then, this is the general model. Even if you're doing the equation approach, this is what you're doing. You're just directly computing all of these inside. You just don't actually see the flow particularly. Another place you're going to have problem is this SQ is a bit of a trick, right? In fact, often I write SQA, which is standard quantity allowed. You have to be really focused on the definition of this. It's a deep thinking kind of definition. That's another little stumble block for everyone the first couple times. You can do it, right? It'll be something you master, but the thinking process has to be just a little specialized and focused. And the first couple times you do it, it'll be just like feeling a little rough, but you can get onto that. The other one is actually down here. The AQ and the SP for fixed overhead is a giant problem. Not the computations are dead easily, but believing that that's what you're supposed to do, because this is a giant violation. So this is an area where we're doing something that really is dumb, but we have to do it. And that is, down here, we are going to do the worst sin, the worst conceivable, immoral, unethical sin that you can do. It's called unitizing a fixed cost, meaning get a per unit version of a fixed cost is bad. Except we have a financial accounting system that makes it mandatory under certain disclosure standards. So you can't avoid it, even though it's really dumb. For any analysis or understanding purposes, you can never do this. It will always be leading you in the wrong direction, always, even though it's necessary for the way we do financial accounting for inventories. And then you have to do it here. And so right in this class, cost accounting class, you're sort of in two worlds right now. You're in the thinking and analysis world, and then you're all, when I say thinking, I meant the business analysis world of making more money. But you're also a little bit in the financial accounting world of applying the financial accounting principles. And this pops up here. Fixed overhead in the AQSP column is usually a giant stumbling block for everybody. And this one's a little bit tougher to get over. Like I said, it's not anything to do with the computations. It's to do with the logic, because they're forcing us to unitize a giant fixed cost. And you know in your gut by now you shouldn't be doing that. And yet here you're doing it. Well, what can I say? Sometimes life sucks. Sometimes we have reasons that we need to do things that are wrong for analysis purposes, but the end is we actually don't analyze this number, but we do need it to do the financial statement preparation that we need. So anyway, so this is the other area that you will sort of, have a problem with. This one and this SQA are going to be stumbling blocks. That one, the harder one, even though that one actually is, that one's the easiest computationally, but it's mentally the biggest shakeup of everything. So then this is our system. And it's a fine system. It has problems with it, like all accounting systems. None of them are perfect. They all have rough edges, because we are, we're trying to describe human life on a flat, two-dimensional sheet of paper or a sheet of, white plastic. That's just never going to work that well. So this is the maximum complexity of Anglo-Axis accounting systems. So in that approach that we have developed in those countries, This is now the maximum complexity. The standard cost that you saw in Chapter 7 plus this hits the maximum. You'll see a couple of little differences on a couple of areas in Chapters 9 and 10. Chapter 9 being a little bit more advanced study of overhead, where we'll get into a lot more, dividing variable and fixed overhead up into, finer pieces. And then in Chapter 10, it'll be activity-based costing. But activity-based costing isn't really more complex than this. It just has a different logic. So it's not more computationally complex. The logic is different, and the thinking might be a little bit complex, but the system itself would be about the same as this. So now talking about some of the weaknesses of this. So you also have two experiences now because of me and because of this book, which almost everybody else doesn't have. Every other cost accounting book, that's out there only talks about the traditional approach. They don't talk about the world-class manufacturing at all. I mean, it will maybe be mentioned in 2 paragraphs in the whole book, and the professors will not mention it at all. I mean, if that would be the case. If you took cost accounting in the winter term here, you wouldn't hear about any of this stuff at all. Now, what you would get a very sophisticated and sharp version or experience with the traditional approach, but you wouldn't get any of this approach at all because, just because that's that person's, stance on things. The people that teach in the winter, they haven't moved the direction I've moved in terms of the world-class manufacturing and things. They're trying to perfect the traditional system. So when we look at this, it has a bunch of problems, but the problems aren't in this model. This model is fine. This model is fine even in world-class things because it depends on what you're trying to do with this model and how you're trying to impact people's lives. So if this model is introduced, then you're also doing something else, okay? This will be the first time I'm mentioning this, but I'm going to spin this around for a second.